So I want to start off this video by understanding the American equity markets. And the question that's been on everyone's mind today is how long will the dominance of the AI and the tech-driven names in America continue? How long will the Mag 7 dominance continue? And I do understand the perspective of higher valuations, and I'll come to that in a bit. I do understand the perspective of Fed becoming cautious heading into December. And there is a question of earnings as well. So we'll talk about all of that in a bit. But right now, let's just start to focus upon the market breadth. How is the market as a whole performing in America? What are the stocks that are performing? What are the stocks that are not performing? So before we come to that, let's quickly have a look at the performance chart. So I have the performance of three ETFs in America in front of you from the April lows that were made this year. So we have the QQQ, which is the technology ETF in America. We have the S&P SPY, which is the S&P 500, and we have the SPXT, which is the S&P 500 X technology ETF. That means that if you bought into the S&P 500 without the technology exposure. So what you can see here is there's a very big performance gap. So if you bought the QQQ, you had a 30% alpha if you had bought the SPXT, that is the S&P without the technology exposure. So you can clearly see the dominance that the AI names or the tech giants have had in the last 6 to 7 months in America. There's another way of representing the data, and that's by looking at the relative strength or the ratio chart. So if you have a look at the top pane, that's the S&P 500 performance from the April lows, and the bottom pane is the ratio of the S&P X technology ETF to the S&P 500, and that shows a clear underperformance of how much the entire market has underperformed the tech sector. So if it were not for the tech names, the markets have been quite poorly performing, as you can see from the charts right over here. So going a little bit deeper and talking more about the market breadth now, because like I said, that's the question on everyone's mind. What I have in front of you right now is the S&P 500 on the top pane. And on the bottom two panes, I have the number of stocks in America trading above the 200-day moving average and number of stocks in America trading above the 50-day moving average. That's a very classical measure to understand what the market breadth is like. So what we're trying to understand here is what are the number of percentage of stocks in America trading above their respective key moving averages. So the 50 number here becomes quite important, quite pivotal. What you can see and how quickly this the macroeconomic parameters have changed in the last 1 2 weeks is quite evident from the screen here. If you look at the short-term market breadth, if you look at the number of stocks trading above the 50-day moving average, we can see a clear cut divergence with respect to performance of price. S&P 500 has been ravishing new highs. It's been testing new highs. However, the number of stocks on each high trading above its 50-day moving average has been declining time after time. So as of today, you have a new high on the S&P 500. You've given a new breakout on the S&P 500 thanks to robust earnings continuing in America. And earnings markets are slave to earnings. But you have just over a 40% number of stocks on the S&P 500 trading above the 50-day moving average. So that shows a conservative bias, that shows the breadth deteriorating in the short term. But if you look at the long-term breadth, that is not very encouraging, but it still remains above the 50 mark, which tells you that the number of stocks trading above the 200-day moving average is still 56. So that's more than 50% of the companies listed in America. Though it is encouraging data, but we do see there is a divergence popping up here as well. So what you don't want if you're a bull in the market is the long-term measure popping below 50. So as long as the long-term measure stays above 50, there is still a consolation prize that's been given to you. But if this number starts to pop below 50, that's clear signals of warning as mentioned by market breadth. If you look at what we call the bullish percentage index, so the bullish percentage index is a measure derived from the point and figure charts. I don't know how many of you look at the point and figure charts. Now it's a classical method of charting that was started by Charles Dow, I believe, back in the 1900s, and it's a very objective way of charting that removes any kind of bias that a technical analyst might have. when trading at the candlesticks or the bar charts. But what this slide tells us is about the bullish percentage index on the S&P 500. So the bullish percentage index tells you about what are the percentage of stocks on the S&P 500 that have a buy signal as per the point and figure chart. Just to give you a small background, the point and figure chart is unlike the candlestick charts, which could be buy. So the candlestick charts could be buy, could be sell, or could be hold. So it has a varying kind of a perspective. But the point and figure charts are binary in nature. They're either buy, they're either sell. There is no other opinion. So this chart tells us, the bullish percentage index tells us about what is the percentage of stocks in America that are currently on a buy as per a point and figure chart. So again, coming from the breadth perspective, you do have new highs coming in, and I do understand where we're coming from, and why trend is so important, because as long as higher highs and higher lows are continuing, nothing else makes sense, nothing else needs to be really focused about. But if you look at the internals, there are some kind of signals of caution that start to come in from here, because we're seeing new highs in the market, but that is only, as per the pointer figure chart, only 50%, roughly 50%, just barely touching the 50% number coming in. That tells us that only 50% of the names right now are on a bull signal, the others are already on a sell signal. So again, that shows the performance gap between the tech and the ex-tech names in America. So like I said, once you start to go below 50 on these numbers, that start to become a little bit more serious. And the way I look at market breadth indicators is they're not trading strategies in itself. And I get this question a lot. These measures are not trading strategies. The way that you need to incorporate them in your analysis is, you start off by looking at the price, then you start looking at volume and the open interest, and then it is the indicators and the market breadth and the macroeconomics, the ergonomics that comes in. So the market breadth does not precede the price action. It comes in much later. So once you start to see the price action deteriorating, once you start to see double tops, lower highs and lower lows, that is when these numbers start to become more highlighted. But as of now, if you look at them, we are seeing some kind of conservative nature, some kind of performance gap, some kind of caution, but they're not actionable claims in itself. They just are a warning signal that you don't want to be too leveraged at this point of time. And once the trend starts to change, okay, that's the time when you want to change from long to short. One of my favorite tools that look at market breadth, again, a very great tool invented by Sherman, followed over by Tom McKellen, is the McKellen oscillator. And this is again a classical market breadth tool. This basically tells us about the short term and the long term market breadth as a difference between the 19 EMA and the 39 EMA of the advance and decline ratio and the stocks in America, the number of stocks participating in America. So, quite simply put, this, if you're above zero, the short-term breadth is good. If you're below zero, the short-term breadth is bad. So currently, the short-term breadth is deteriorating at a faster rate than the long-term breadth. Like I said, again, some caution that is being denoted in America. If you want to look at it, if you want to look at the McKellen from a longer term perspective, you could look at the McKellen summation index. I feel that's quite important as well. And the way that you can understand the difference between the McKellen and the McKellen summation is how you perceive volume and on balance volume. So if you look at the volume bars in your classical trading view software, you would see that below the price you have volume histograms popping up. So they tell you every single day's volume contribution. But if you want to compile this data and get a more structured understanding of what the volume tells you, you want to put an on balance volume, which is an index, which is accumulating every day's volume histograms into an index. So that is basically what the McKellen summation index tells you. It is accumulating each day's oscillators values and giving you an understanding of the long term breadth. So again, you can see divergences, you can see the markets going higher, but the market breadth in the long term not corresponding to that, which is very similar to the momentum divergences that we have seen so far in American markets. But like I said, as long as you're above zero, you're fine. But once you start to go below zero, that's when the problem starts to come in. So there's a good example of the 2024-25 rally. The McKellen remained above zero, which corresponded to good rally in the market. You had some choppy phase in 25 thanks to tariff by Trump, which showed some nervousness in the markets. And then again, now you're above zero, so that shows a good healthy uptrend. So now when you go back below zero, that's when the matter again changes hands. Another chart I have for you on the market breadth is about the new highs and new lows, and that's again a very minuscule measure, but something which offers a lot of insights. So the basic understanding behind this is that when the markets are in a bull trend, it's doing fine, it's doing well, it's a healthy rally. There's a broad participation in the rally. What should happen is when the markets make new highs, that should correspond to more number of stocks making new highs than new lows. Think about it. If the markets on a whole, the S&P 500 is testing a new high, you should have in the individual stocks in the participation, you should have more highs, more new 52-week highs. If you see what's happening right now, and if you see what was happening earlier, this is the 50 MA and the 200 moving average, you could see that the green is the number of new highs every day. The red is the number of new lows, and that's on the New York Stock Exchange. That's the S&P 500. That's the Nasdaq. So if you see what was happening in the earlier part of the rally, when the tariff news improved, when there was more hope than fear with respect to Trump tariffs, so you could see that there were a lot of new highs being made as compared to the new low. So markets are testing higher levels, and there are new 52-week highs being made as compared to 52-week lows. But if you're seeing what's happening today in the last couple of sessions, which is something again very intriguing, and I ask the question why, is the markets are have given a very recent breakout. It's given a good breakaway gap as it looks, as it appears to be. But there are about 77 new highs being made, but 91 new lows being made at the current juncture. So why would you do that when the market is bullish? Why are there more new 52-week lows than the new 52-week highs? That's another very, like I said, a minuscule measure, but offering some very important insights about market breadth. And this actually becomes quite elevated when you look at the NASDAQ, because that shows us as of today 126 new highs are being made as compared to 214 new lows being made. So there is some kind of divergence coming in here as well. And finally, I want to look at the measure that we're all waiting for, the advanced decline lines. So I have the S&P 500 comfortably moving in a parallel upward channel, showing the market strength, showing the market trend. But I do have the advanced decline lines of the S&P 500, the Nasdaq, the mid cap, and the small cap. This is the NYSE, sorry. So if you look at the S&P 500, we don't have any divergence on the advanced decline line. We have a healthy uptrend on the price, and we're also getting a good parallel upward channel on the advanced decline. But if you start to look at the NYSE, you start to see, though there is not a lot of massive divergences, but we are not corresponding to higher highs on the advanced decline line. We're getting higher highs on the price, but we're unable to get the higher highs on the advanced decline line on the NYSE. So that's a matter of concern. If you look at the mid and the small cap, that's where this issue gets quite elevated, quite highlighted, because the new highs on the S&P 500 are not getting confirmed by the new highs on the mid cap and the small cap. Small cap, ever since the start of the year, has been very truncated. We haven't seen any crazy behavior happening over there, and same is the case with the small cap. So we would require these numbers to be topped for our healthy uptrend, for our leveraged bets to again start in America. So the conclusion that we get from a market breadth analysis is, of course, leveraged bets need to be off at this point of time. And the way that you need to understand this is, market breadth, like I said a little bit earlier as well, is not a trading strategy in itself, but it is a way to, it's a roadmap, it's a way to guide you. It's like when you're at a traffic signal, you need to know how to drive the car. And then when the signal traffic lights turn green, that's when you hit the accelerator. But if you don't know how to drive the car, those traffic lights don't have any meaning to you. That's how I understand market breadth or trading indicators per se. So just kind of concluding this section over here, if you want to, if you're a bull in the market, if you understand that this is a good market for you want the market breadth indicators improving. You want the number of stocks trading above the moving averages to go above 50. You want the bullish percentage index to hold the 50. You want the McKellen to go back above zero. You want the number of new highs to go back up, number of new lows to go back low, and you want the advanced decline lines to confirm. You want them to start to chop higher. You want a broad based participation in the market. So at the same time, if you're a bear, the other second thing that we need to discuss about is the US dollar index, and it's a very important measure, often missed by a lot of people. But something very interesting has been happening lately in the US dollar index. Just to explain very quickly, the dollar index is how strong is the US dollar as against the six most traded currencies in the world with the US. And it includes names like Japanese yen, euro, pound, Canadian dollar, so on and so forth. So the US dollar movements, index movements, denote and affect how risk assets move. For instance, if the US dollar starts to move higher, that denotes weakness in the commodities, weakness in the cryptocurrencies market, and most importantly, for you and me, weakness in the emerging markets. What you need to understand is capital, as much as you have it all over the world, is limited. When you see the US dollar going higher, that's a great signal for institutions, foreign institutions, for instance, to pull out their money from the risk assets like emerging markets like India and to pull it back into risk-free assets like treasury bills, which again pops up the treasury returns in America. And once the US dollar starts to again go in the downward trajectory, that's another wake up call for the institutions to pull out money from the treasury bills, treasury notes, and park it back into the riskier assets like India in the emerging markets. So it's always important and vital to track the movements in the US dollar index. What's been happening right now is that US dollar moves in long-term secular cycles. That's a given. The US dollar moved in a very downward trajectory back all the way from 2025 once the tariff drama started from 110, it moved all the way till about a 96, and that has popped up the equity behavior in the last 6 months or 7 months. You've seen the Indian markets ravishing up to the highs. Japan's moved up to an all-time high. The American markets are doing well. So you can see that negative correlation between the two, the risk assets and the US dollar index. You've also been able to see how declines in the US dollar has given you good returns in the cryptocurrency market and more importantly, good returns in commodities, silver and gold, for instance. But now what's been happening is if you look at the daily chart, so I want to look at the daily and the weekly chart. If you look at the daily chart, I have the Ichimoku cloud. I'm not going to put more complex charting for the sake of our audience. But if you look at the Ichimoku cloud, you just started to pop above the Ichimoku cloud. So that shows short-term bullishness that is starting to come into the US dollar. And if you look at the trend line that we made right from the May and the August highs, you've seen how that trend line has also been popped and broken higher. So there is some kind of bullishness that appears to be starting from in the US dollar index. What is very important here is to understand from the top down perspective of what's actually happening on the weekly chart, which is very much more interesting. If you look at the weekly chart, you can see that dollar is actually sitting on a 14-year support. The question here is not to predict. The question here is to understand based on the policies, based on the announcements that follow, based on the economic developments that take place. Is this the start of a new downtrend for dollar if this breaks, or is this a massive support and dollar popping up back higher? Because if at this point, so you might have a short term strength which could be a potential headwind for the equity markets, for the commodity space, for the cryptocurrency space, of course. But if in the longer run this turns out to be a breakdown of the long term trend line, that is where massive amounts of money will start to again pour into emerging markets like India. So, your stance as an investor really depends upon the movements in the dollar index going forward 1 month, 3 months, 6 months down the line from here. So in the short term, we do have some hindrances that are coming in over here. If you look at the daily charts, you're getting, back to back, you just got what they say, a three white soldiers on the candlestick charts. We've got some new highs in the recent times. We got the highest price since the August levels on the dollar index. So closely tracking this will make a lot of sense. If the dominance continues, that's gonna be a headwind for India. That's the reason why the 26,000 number in India has not been able to break so convincingly yet. But if we do see finally going forward the dollar index starting to break below our 14-year support, that's where your massive exposures into the equity segment must. So let's talk about the earnings of corporate America. Last week, we saw one of the busiest weeks so far on Wall Street with giants like Amazon, Meta, and Alphabet posting their earnings so far. And if you think that's enough, the next week gets even busier with the AI giants like Palantir, AMD, Microchip, and Qualcomm reporting their earnings so far. So here's where I remember the advice of Benjamin Graham, who said, in the short run, markets are a voting machine, and in the long run, the markets are a weighing machine. And the markets will always remain a slave to earnings. So in the short run, market represents values like emotions like fear, greed, hope. And in the long run, market weighs in principles like profitability, assets, and turnover. So if I was you, I would be tracking the SOXX ETF, which is the semiconductor or the AI ETF in America. And what you need to understand is, as of now, I'll give you some statistics. Heading into this quarter of earnings, America was expecting only a 7% growth in the earnings for the S&P 500 companies, thanks to the fragility around the uncertainty around the Trump tariffs and policies. But since now the 70% of the companies in America have reported their earnings, and it is expected to be the fourth quarter of double-digit jump in the earnings of the S&P 500 companies. So as long as the earnings of the companies remain robust and their guidance for the future remain robust, then the trend remains intact. So what you want to be tracking next week is, are there any disappointments in these AI-led companies? Are there any disappointments? Are there any margins not being fulfilled for these AI-led, semiconductor-led companies? Because if there are disappointments, then fragility in the trend starts to set in. That is where the trend starts to stall or starts to crack. But if these outperform their targets, outperform their expectations, then the trend is still. You don't want to fight the Fed, and you don't want to fight the tape. So you want to stay in the trend as long as it remains intact, but at the same time, you don't want to mess around with the Fed. Last week, you had the Federal Open Market Committee announce a 25 basis point rate cut, very well expected by the market. But most importantly, the ongoing hawkish tone has been established for December onwards. Fed Chairman Powell has clearly stated that further rate cuts are no longer a foregone conclusion. So let me explain a little bit around the federal monetary policy. American central bank has to follow a dual mandate, just like any other central bank of any other country. America has to not only achieve price stability, which is keeping inflation in check at 2%, but they also have to keep in check the full employment and the economic growth prospect of it. So let me give you an example with respect to India so that you understand things a little bit better. RBI, they can change their monetary policy by either changing the repo rate, by changing the OMO, doing the OMO's open market operations, or by changing the cash reserve ratio. So thinking about the repo rate, it is very similar to the Fed funds rate. The repo rate is the rate at which the RBI lends money to the commercial banks. If assume the repo rate is at 4% and the RBI changes the repo rate from 4% to 6%, the impact that it has is now the money is available to the commercial banks from the RBI at an expensive rate, which means that now the commercial banks, when they have to lend money to the consumers like you and me, they will further do an hike in the interest rates that are available on the loans advanced by them. So what that does is that reduces our likelihood to avail those loans. So if we don't take those loans, we curtail back on new investments to set up factories. The profitability of companies reduced thus far. So we see a lackluster movement in the market. We see the markets going through a declining phase. But at the same time, when the repo rates are reduced by the RBI, let's say the repo rates come down from 6% to 4%, this in turn reduces the loans, the rates charged by the commercial banks on the loans given to you and I from, let's say, from 8% to 6%. Thus, you and I would like to avail more loans because loans are available at a cheaper rate. I would like to avail more loans to set up new factories, to set up new plants, to make more investments. Thus, the share market's profitability improves and does well. So the repo rate or the Fed funds rate in America, which was just cut, is very closely linked to different parts of the economy. Now, you also need to understand that changing the Fed funds rate or the repo rate has very clear impacts for inflation and for the employment aspect of it. If the repo rate is increased, that is done to reduce the inflation because people are taking less loans. If people are availing less loans, this would reduce the money supply, thus it cuts down the inflation. But the impact that it will have, the coin always has two sides. Not only does it reduce inflation, but it will also reduce economic growth as people don't take more loans and they don't set more factories. At the same time, if the repo rate goes down, people would like to take more loans. So not only is the inflation going higher, which is a risk, but economic growth, employment is also getting lifted. So a central bank at any point of time always has to understand what is the priority. Is the priority to keep inflation in check, or is the priority to keep employment, economic growth in check? Right now, when I talk about America, America has been in a pickle. Not only are they under the stress of a government shutdown, by the way, it's been the second largest, longest government shutdown recorded in history. Earlier last month, you had Republicans and Democrats not able to agree on a funding bill. So the non essential services of the government have come to a standstill. Services like releasing the non farm payroll by the Bureau of Labor Statistics, which I'll come to in a bit. So if you see America, America's inflation, CPI, has been reigniting, it's been reaccelerating. So keeping inflation in a check, which is the 2% is the price stability goal of the Fed, has been quite a key, which has been reaccelerating in the last couple of months from 2.3% now all the way to 3%. At the same time, there's another problem. The non-farm payroll, which is the jobs data, which is the employment data of America, which is the number of jobs in the private sector added in America every single month, that is on a contractionary trajectory. And not only that, we're at the helm of negative job growth, which is very rare that you see in history. America was recording addition of job of about 150,000 jobs every single month, but that number has now come down to 22,000 jobs. And more importantly, this data has not yet been released last month, and it is also not expected to release on November 7th, which is the expected date of release of the data. Thanks all to the government shutdown. So, with in absence of this data, how do you expect the Fed to take constructed, informed decisions? And that is what is neglecting the Fed to take in further decisions and commit further rate cuts. So, the main crux of the problem here is that the Federal Reserve, more than stopping inflation right now, they want to increase the non-farm payroll. They want to get the maximum employment back. So for that, they want to cut interest rates. If you see the trajectory of your Fed interest rate, the Fed funds rate, you can see that the Fed funds rate has been kept stable for a very long time. Last month, last policy, you saw that 25 basis point cut, and just this week you saw a 25 basis point cut. So now it's currently in the range of 375 to 400 basis point. This is being done to re-accelerate your non-farm payroll or the job sector in America, which is already facing a lot of problem. You have already read the reports of no one is hiring, at the same time everyone is firing. There's a lot of problem happening in America. But at the same time, like I said, it comes at a problem. If you keep cutting rates aggressively and the uncertainty of tariff at the head of America, this also has the risk of reigniting inflation, which it already has done. And this is the reason why exactly the Fed's in a pickle now, saying that further rate cuts are no longer a foregone conclusion. If you look at the CME Group's FedWatch tool, this will offer a lot of insights why there has been nervousness in the markets in the last 2 days. You've seen India sell off from its highs, you've seen America sell off from its highs. And what you can see here is that just 1 week before, if you understand what's the probability of rate cuts, what the market is expecting for December, just 1 week before the Fed meeting, you had a 91% probability that the Fed will do a 25 basis point cut in the December meeting. But now that number has gone down to 63%, which is almost a 2020. So I'm completely for the global interconnectedness of the markets and the intermarket relationships that we share with one another. And a question that might be popping up in your minds is, does the Fed funds rate changes have impact for Indian markets? And the answer is yes. Think of it as this way. You have an opportunity to invest in a large cap and in a mid cap. The large cap's giving you 10%, the mid cap's giving you 11%. Would you put money in the mid cap? Probably not, because of liquidity, credit constraints, just for that 1% alpha. But if the large cap's giving you 10% and the mid cap's giving you 15 to 16%, you have that 6% alpha, which might let the investor strongly consider investing in that mid cap company. I'm not saying India is a mid cap or India is a small cap or a large cap, but that's the example that I want to explain you this with. India is a triple B economy, rated economy, and America is a double A plus economy. So India and America have to keep a differential between their risk-free rate or the 10-year treasury yields. If you look at the treasury yields right now in America, the risk-free rate is 4% in America, and in India it's about 6.5%. The risk-free rate cannot be reduced drastically as compared to America, because if there is hardly any gap available between the two treasury yields, that would lead to investors, institutions pulling out capital from riskier markets like India and putting it back into America. So when America is cutting rates, it's cutting rates. India also gets that ability to do rate cuts, which is eventually bullish for it, because it has to maintain that 2.5% valuation difference. At the same time, America remains where it is on the 10-year treasury, or the Fed funds rate. Basically, the Fed funds rate changes will change the 10-year treasury rate. So if America remains status quo, for example, in December, India also cannot further reduce their or cut their treasury rates, because if it does so, it reduces that margin, which will lead to investor pulling out money from markets like India. So I hope you understand the correlation of the treasuries that India and America and the gap that they maintain is. The other thing I want to talk about is a question that I see a lot on social media is, we're very similar to the tech bubble burst that we've seen in the past. See, there were a lot of differences, and just purely speaking from chart perspective, there were two or three very important considerations that were happening at that point of time, which are not currently shared. First of all, in 2000s, earlier 2000s, you had copper, which is the health of the economy, plunging below the 200 daily moving average, signaling slowdown fears. That is no longer the case right now. Copper, as of now, if you have a look at copper, it's currently comfortably positioned and in an upward trajectory. The second thing that happened at that point of time was the consumer staples, which is the sectors that have inelastic demand, consumer staples, they were blasting, they were going higher, and the discretionary sectors, the demand for which could be delayed, they were going down. Again, that's not what's happening at the same time right now. If I show you the example of the consumer staple to discretionary, this is the discretionary sector in America, which is comfortably near a breakout. If you look at the consumer staple sector in America, this is near the low. So again, we are not seeing the American slowdown fears as such as being portrayed. Like I said earlier, there are valuation fears that are out there, but earnings are justifying that till today. The other thing I want to talk about is the concept of modern Dow theory. If you've been into technical analysis, you probably stumbled upon the concept of Dow theory, which is you look at confirmations between the Dow Jones Industrial Average and the Dow Jones Transportation Average. I do believe now that's a little outdated. So the concept of modern Dow theory was introduced, in which you look at what is the performance of the American markets, look and the global ETFs. Are there any confirmations in that? So if we have a performance check between them, so you can look at the S&P 500, which is in a good healthy trajectory on the upside, making new highs. It does have a doji right now, but that might or might not have any meaning, but that does show maybe a trend stall could take place. But if we compare it with our ETFs, in the world. So we have the Eurozone ETF, which is again, as you can see, it's in a comfortable uptrend, making new highs. You have the French ETF, again, comfortable looking at new highs. You have Spain, which is looking at new highs. You have Netherlands looking at new highs. You have Italy, and you have Germany, little bit subdued, but looking at new highs. So we do have participation from throughout the world in similar sentiment. Similar is same by Japan, China, and India at the same time right now. So the other thing I could talk about also is looking at your the risk assets or the digital assets like cryptocurrencies. Bitcoin, for example, is at a very pivotal point. You have had a great 2.5 year trend line that's been coming in from the lows. And I would like to track the movement of dollar like I portrayed a little bit earlier, because any significant changes in dollar would have significant impacts for the cryptocurrencies. If you have the dollar finally in a secular downtrend breaking, that would start the wave of trend for Bitcoin on the upside. But if the dollar starts to become stronger and you have the cryptocurrencies finally breaking that 2 3 year pivotal support line, that could be a very interesting part to see where the risk assets go, because that's a detrimental thing not only for the digital assets but also for risk assets like equities. Looking at American markets now, so we have the 20 and the 50 and the 200 moving averages placed, which are comfortably in the rightly aligned in the position of an uptrend. The advice that I want to give you at this point of time is more money is lost in finding a top than actually made in trading the top. So what are the key points that we're looking at here? So you're seeing the market breadth deteriorating. Does that have any significance? Let's talk about that. You're seeing dollar rebounding. You're seeing Fed in a pickle. So what does that fare for? At the same time, there is strong earnings. So how does that fare for the markets? Talking purely from a chartist perspective, not from a prediction point of view or a forecast point of view, purely from a chartist perspective, the most importance is, first of all, looking at the moving averages, which is completely aligned. We don't see any crossover. We don't see any misalignments. The shortest one at the top and the longest one at the bottom showing comfortable momentum and direction. The second thing that you always want to keep a close eye on is the gaps. Right now, if you look at the American markets, the benchmark, the S&P 500, you do have 2 or 3 gaps which have been created. As of right now, they look like breakaway gaps. Breakaway gaps signal fresh trend, new momentum. What you need to understand is, if breadth is an issue and if dollar rebounding is an issue, and if you want to become cautious and reduce your leveraged bets in the market, you would first want the markets to fill these gaps. Because if these gaps get filled and the markets come down and take away those price vacuums, then these no longer are breakaway gaps, because breakaway gaps do not get filled. The second, so that would be the signs of maybe the trend stalling, maybe the trend now coming to a standstill, could be a sideways trajectory, maybe after some positive or negative financial triggers, catalysts take place for the fresh trend to start. That would be the first sign of caution. The second sign, of course, is our traditional technical analysis, traditional chart, which is what is the trend right now? You're in a comfortable uptrend, which is signaled by higher highs and signaled by higher lows. You had you had the last lows in July, comfortably positioned at 20th August. Then you had further lows in September, which were quite comfortably held, and so on and so forth. At the same time, you have higher highs in July, in August, in September, and now in October and November. So if you want the trend to become fragile, if you want the trend to reverse, not only do you want to have the gaps starting to get filled, showing confusion and showing the breakaway gaps turning into exhaustions, you would also want the last supports or the last lows starting to crack. That would be the traditional sign that says, okay, the breadth is deteriorating and the chart is confirming that we need to change our view from up to down. But at the current point of time, another thing would also take place if these gaps don't get filled, and if you don't have the moving averages change the order, you don't have the uptrend, which is the higher low changing. There could be a time of sideways price action movement where the breadth starts to improve, and that could lead for the chart to continue its uptrend. So this is the situation that you're in America, and what you need to understand before you take premature decisions whether or not you take America or you take it away and put it on different markets that you trade in, different asset classes that you trade in. The same thing is the case for the Dow Jones Industrial Average, and the same thing is the case for the small cap index in America. The small cap has shown a little bit of a consolidation, a little bit of not such confirmation as compared with the Nasdaq and the S&P. But it is very important to see how the trend rolls in from here. Let's finally circle back to India. Foreign portfolio investors have finally made a comeback into the Indian stock market. They've purchased in the month of October $1.65 billion worth of Indian stocks, and this is after being net sellers in the Indian stock market for the preceding 3 months. Secondly, the recent GST rationalization has been a very big key driver for the Indian growth story. Look at the auto companies. Auto sales data came out today, and companies like Tata Motor passenger vehicles, Mahindra and Mahindra, and Hyundai, they posted much bigger numbers than they did in September. The GST collections, for instance, they rose 4.6% in October. And also, there is expectations of the corporate earnings from the current quarter to increase, which is also going to be fueled by the 21 to 22% drop in the crude oil prices that we've seen from the 52-week highs. So there is a lot of positive developments that have rolled in. If you asked me about how is the India story 6 months ago, we were in a time of trouble. We had a time when there were no earnings. We had the tariff uncertainties. We had massive, highly overvaluations of Indian companies and having no guidance and earning visibility 6 months ago. But the picture has changed drastically over the next 6 months. Thus, we've seen a good 1,300 point rally because, like you know it, market is a discounting mechanism. But there is one instance, the trade deal between US China, the trade deal between US India, that still remains a key trigger. You all know about the mercurial nature of President Trump, and the final outcome thus remains uncertain. You never know what you are going to wake up to, what kind of tweet are you going to wake up to. So that always remains a key risk in the market right now. So if the deal doesn't go well, it would hurt India's exports, and it would lead to the foreign money and the capital flowing out once again. So, with respect to the Trump tariffs, you had the India and the US 50% tariffs on and off quite some times. You had the US and China tariffs on rare earths, and then again back and forth on them quite a few times. So, like I said, it's quite uncertain. So, we've talked about in this entire video over the last, I believe, 30 to 40 minutes about what are the goods and the bads. We've talked about the bad market breadth America is starting to witness. So, will we see improvement in the market breadth or further deterioration? That is something we need to track, but earnings remain solid. So, as long as the earnings remain solid, that is going to help America remain its elevated position that it has done so far, thanks to the AI and the tech giants. We talked about dollar, which saw some, which seeing some daily charts breaking out. We're seeing some short-term improvement in strength, but what happens going forward as it is on a pivotal role remains to be seen. And we've talked about how nervousness has crept into the world markets thanks to the Fed's watchful and the hawkish tone going forward from December. So let's have a look at the Indian charts as well and see what they are trying to tell us. If you look at the Nifty market, Nifty, and we can have a look at the daily charts, we got a great support back in the 24,500 level. That was a very solid, resolute support, and then improvements in the tariff front and in earnings reporting done in the current quarter have seen some great 1,300 point rally. But what we're seeing right now is from the lifetime highs, approximately 100 points away from the lifetime highs, we're starting to face some overhead resistance, and that is quite explainable when the Federal Reserve starts to become hawkish, and that denotes the global money movements. So we're seeing what we say call a double top, and it's very important to see how that fares going forward into the next week. We do have a holiday in the next week on Wednesday, which I believe would be when you will be seeing this video. But this is a development that we would like to track. If you look at the weekly charts, we are seeing a new high that was made in the current week, but the market is closed at the low of the week. So that's a little concerning as we're at the 26,000 overhead resistance and the 26,300-400 lifetime highs that we've made. So we are sensing increased supply pressures at the top. So you will need to top these two tweezers or the shooting stars or dojis that you've made to resume that upward trajectory of the uptrend. But for now, we're getting the sense of increase of supply and reduced buying. So looking at the daily charts once again, there is a little bit of a caution that is warranted because the double tops are the typical, are the classical, the reversal patterns that we see on the charts. Once, if this pattern starts to unravel and the market starts to break lower, we've got the lowest closing on Friday this week. So the weekly close has come, lowest close has come on the Friday. So it is expected uh, some caution to be warranted in the next week. Once the market starts to come down, Fibonacci's could be used from the current rally from the swing low to the swing high to see where the markets can find some stability. So if I can just put a Fibonacci for you, we do get some supports at 25,700, 25,519, 38.2, 50%, 61.8%, and so on and so forth. So I believe it's a lot got to do with the macroeconomic environment and how the rest of the corporates start to post their earnings. Bank Nifty, of course, is showing similar environment. You're seeing establishment of double tops. And one statistic I would like to give you, if you're a reader, Thomas Belkowski has been a great statistician on the markets. And one thing he said was when you start to see double tops in the market, you want to make sure they break down before you make an opinion. So for example, you're seeing Nifty Bank trying to make that double top near the all-time highs. So you can only say it's a double top and start to become cautious once you start to break below the neckline and the lows made, because otherwise 64% of the times if you make a premature decision, the double tops actually carry out in their original direction and turn out to be a descending triangle breakout on the upside. So just some technical learnings from you from my experience. So these are two things you want to track. If you're a bull in the market, if you're someone who's more aggressive on the bull side, if you see that case working out, you just want to wait for the markets to go back above 58,000, for the markets to go back above the 26,100 zones to start to reignite the strength that they have so rightfully showed in the last 1 month or so. The third thing I want to talk about is the India VIX. How surprisingly and how under the hood it's slipped and it's actually gone up quite a lot. It's still at 12 and it's nowhere in comparison to what America trades at. But if you trade in the Indian markets, you've probably been trading at a VIX of 9 to 10, 10.5 for the last couple of months, which has been quite annoying if you're an option seller or even if you're an option buyer facing lack of momentum, lack of volatility, which is how you really want to make money in the markets. But why is the implied volatility going higher is the question that you want to keep at the back of your mind, because implied volatility or the VIX, which is the 30-day implied volatility of the benchmark Nifty, it does go higher when there is increased buying of puts and calls taking place. So there is an increase in demand of options as compared to 1 to 2 months ago. So this is something I want to keep in mind. Are we near? Are we starting to see? Are we going to see a trend in the near future? Is that what it is signaling us? So we might be too early for this, but that is something I want to keep for my next video. If you look at the other sectors, let's talk about the IT. IT has been quite subdued, and so has pharma been quite subdued because of the overhang uncertainty with respect to the IT, and pharma is a heavily exported service from India. So with respect to the 50% India-US trade war that's been going on, that's one of the reasons why you're seeing a lot of subdued nature of IT and pharma. You're seeing a good pressure, good movements coming in banking. You're also seeing good movements coming in auto sector. If you look at the weekly charts of auto is trading at its lifetime highs, and we did see a flag kind of a formation breaking out with a breakaway gap in the 18th August week, thanks to the GST announcements that were made earlier. And if we look at the targets, we still have 30,000 levels, which is open. So that could be something quite exciting if the passenger sales that have come up boost the sentiment of auto and give you a new breakout on the auto industry. That could be something worth watching. Auto stocks still look quite hot and not intimidated yet from the global macro announcements. If you look at realty, another thing that is quite exciting is real estate, because lower interest rates are good for the real estate sector. But what we're seeing is we have seen a triple bottom breakout, in the last 6 months or so, but we aren't seeing any kind of conclusive behavior after the breakout. So that's something which kind of bothers me. And this is something that we're also seeing in Nifty, finance, and banking right now. Even though they've done very well, we're trying to see those double tops marked. So we can't really become aggressively bullish, once again, because of the entire list of good news that we have. We'll have to pace ourselves accordingly. We'll have to pause and rethink that maybe has the markets done their course of moving 1,000 points higher? Are we again going back to that huge time correction that we saw in the last 1 year? So these are some questions that still need to be answered, and there are a couple of announcements yet to be made, which we need to closely track. Another thing that kind of takes my attention is the small cap index. In America, the small cap is quite replicating the large cap index, but small cap index in India, first of all, have had no earning visibility and valuations close to 40-45 on the PE. So that is the reason why you're seeing the small caps haven't outperformed so much as they have done in the past as compared to the mid cap and the large cap. I did, have talked about this concept quite a lot of times in my platforms. But we're again seeing some overhead resistance coming back from the small cap space. Another interesting part is Nifty is at the lifetime highs, but small cap is still trading about 1,000 point away from its. That's about 7% away from its lifetime high. So that's just a small thing that we would like to keep on record. So that's just a bit from my end for now. I hope you enjoyed the entire video that I compiled with respect to where we are with respect to the macroeconomic. What are the good things that's happening right now? What are the bad things that are happening right now? So we can all take an informed decision. I hope you enjoyed this, and I'm looking forward to see you soon on the channel of Grow.